Today's scenario involves a 27-year-old named Rick who thought he could take advantage of a market downturn. He had access to a large amount of credit and decided to borrow money at zero interest using credit cards to invest in stock index funds. His plan seemed simple: buy when prices are low, wait for a rebound, make a profit, and then repay the borrowed amount. However, things didn't go as expected. Instead of rising, the market dropped further. What started as a $30,000 investment, converted equivalent, is now worth much less, leaving him with a significant loss and a looming deadline before interest kicks in on the borrowed money. Now he's stuck with a difficult decision: sell now, accept the loss, and repay the debt, or wait and hope the market recovers before interest charges begin. The real issue. The biggest mistake here wasn't just the investment, it was using borrowed money to try and make quick gains. There's a common belief that you can beat the system or get ahead quickly by taking shortcuts like this. But in reality, chasing fast profits often leads to bigger losses. There's a reason steady, long-term strategies are recommended. They're far more reliable. Choosing between two risks. Rick's situation comes down to choosing between two types of pain: taking the loss now, accept the current damage and move forward; waiting and risking more loss, hope for recovery, but potentially lose even more if things don't improve. The problem with waiting is uncertainty. Markets can recover, but no one can guarantee when. Delaying could make the situation worse. A hard but valuable lesson. Losses like these can be thought of as a learning cost. It's the price paid for making a risky decision without fully understanding the consequences. Many people go through similar experiences at some point. The key difference is whether they learn from it and avoid repeating the same mistake. What should be done? A more cautious approach would be to stop the risk from growing further, pay off the debt as soon as possible, focus on rebuilding finances without relying on borrowed money. This might require extra effort, working more, cutting expenses, or finding additional income, but it helps regain control. The underlying mindset. Situations like this often come from overconfidence, the belief that you can outsmart the market or make easy money quickly. In reality, financial success rarely comes from shortcuts. It's built through discipline, patience, and consistent effort over time. Final takeaway. Using credit to invest, especially in volatile markets, is extremely risky. When things go wrong, the consequences are amplified because the money isn't even yours. The positive side, Rick is still young, and the loss, while painful, is recoverable. More importantly, the lesson learned here can prevent much bigger mistakes in the future.